Hi, we'll start momentarily.
Hi, this is May 11th, 2020, and this video conference is going to deal with how to recession-proof your life. Now, the recession has not yet been announced, so you might be wondering, well, is Natalie being alarmist? Are we really in a recession? Won't we have this amazing recovery after we open up and after we beat this pandemic? And the answer is it's in the numbers. Look, if you're confused by the noise that you hear in the mainstream media, the right answer is going to be that you want to trust the numbers. You want to trust results. So I want to show you some data, statistics, information so that you know I'm not being alarmist. I'm looking at the numbers. I am listening to the economists. I'm reading the data. And actually, it's not even most of the time. I don't watch or listen to the news. Now, why is that? Well, actually, a lot of what you hear on the news is going to be late. So as one example, we already know we're in a recession. There's no economist that even quibbles about this. And once you see the charts, you'll know it too. But it won't get announced until July 30th. Now, why is that? Well, we can't announce that we're in a recession until we have definitive proof that we're in a recession. And the definitive proof doesn't come until we have the second quarter GDP results, and those get announced July 30th. However, the data is already pouring in, and you don't have to be Cassandra to read the tea leaves on this one. So let me show you some data and statistics. The first one is going to be this chart. This is the GDP that we had that was just recently reported. And as you can see, it was minus, I believe, 5.6%. So this just shows you, and this is from the Bureau of Economic Analysis, the BEA.gov. And this is already out there, so this is publicly available information. So 5.6% minus, negative. Okay, so it takes it takes 2 quarters of contraction for us to technically be in a recession. The recession has started, and the date of the recession is always the top of the market, which was February 19th, 2019. However, we don't get declared in a recession until we have those 2 quarters of contraction that have been reported. That happens July 30th. So let me go back to more charts so you understand what's going on. Now, here's an asset chart here. Yeah. Okay, so these are the projections from the experts, the Federal Reserve Board, market participants, Fitch ratings, economists of that caliber. So as of May 8th, we had 18% unemployment, inflation, we were in deflationary period. GDP growth is predicted to be minus 5.6% for the full year. The second quarter is supposed to be down another 12% over the first quarter and 40% over the second quarter a year ago. Let me show you another chart that I think is important for you to see as well. Oh, I'm going to show you that one. Well, okay, I wanted to show you one before that one. I think it's this one. Yes, and then I'll show you that one. So this one is the jobless claims. Now, this is a chart that goes back to 1960s. It doesn't go back to the Great Depression, although people are actually sadly comparing what we are currently experiencing. They worry that it could have Great Depression, like not recession, not 2007, 1929, Great Depression like characteristics. And this is one of the Great Depression-like characteristics that we're seeing. So we're probably going to hit, well, we are in over 20% unemployment right now, but it's possible we could hit 25% before we hit the peak. And this is the jobless claims. So as you can see, when we had the first jobless claims report, it was just astronomical, and it is far higher than we have ever experienced since they started recording jobless claims back in the 1960s. Again, chart is not going all the way back until the Great Depression. But as you can see, every time we had this kind of spike in unemployment, we had a recession. Pretty close to every time. So this is something for you to be aware of, right? Are we in a recession? Yes, we are. And then here's why it's important for you to know that we're in a recession, because, and I'll come back to this chart in 1 second, I want to explain this to you. So prior to 2000, we were generally in a growing economy. So when we had recessions, you know, they would go down and then they could come up and recover okay. So essentially you could use buy and hold. Like from 1960 to 2000, buy and hold worked okay. It worked pretty well. I mean, modern portfolio theory with annual rebalancing would have worked better, but if you had buy and hold, that would work fine. And honestly, it was more difficult to actually diversify properly and to do annual rebalancing prior to when we had the internet become pervasive. Since then, it's become relatively easy if you knew how to do it, or if you got the memo that it was important to do it. Now, the charts I'm going to show you are going to tell you why it's important to do this, because the 20th century strategies like buy and hope, which worked fine in 1960 to 2000, are really terrible in the 21st century. And here's why. So in the dot-com recession, and this was 2000 to 2002, the NASDAQ lost 78% of its value, and it took 15 years to come back to even. And then you had the Great Recession, I think that's this chart, and the Dow Jones Industrial Average dropped 55%. Now, what happens is that it's not a crash. It's not ever a crash. And what we're experiencing right now is what happens normally in a recession, where it's a series of unfortunate events that are followed by tiny rallies, and then another unfortunate event, a tiny rally, unfortunate event, tiny rally, and then finally we hit the bottom. It's usually about 18 to 24 months before we hit the bottom. So what happened in mid-March, so from February 19th to early March, the markets dropped 35%. Now, the markets have recovered a little bit, but they're still down about 20%. Now, people are saying, well, why did they recover at all if we're in a recession? Because we have a multi-trillion-dollar financial services industry full of broker salesmen who call up their clients and say, this is the opportunity of a lifetime. You can buy low. Now, is that a good strategy? Well, annual rebalancing is a good strategy provided you have enough safe. But if you don't have enough safe and you lose more than half every recession in the 21st century, and all you can do in the bull markets is pray and hope that you crawl back to even, that is not a good strategy. First of all, you're losing half your wealth. And when that happens, your FICO score really crashes. You might be stuck in a home that you can't afford. The opportunities dry up because you're so illiquid. So it's not just that your wealth goes down and then it can come back up. During that recovery, it can be hellish. So what is a better strategy? Well, modern portfolio theory with annual rebalancing is a better strategy. It's something that I developed in 1999. It's something we started using. It worked great in the dot-com recession. That's how I got into this business. I'll tell you more about that in a minute. And then it worked fantastic in the Great Recession as well, because by that time I had enough people that were following the strategies that they were implementing it and thanking me, and, you know, love letters galore. So let's look real quickly more a little bit into the data, and then I'll come back in with how you can recession proof your life, how you can vet your guru, whether it's me that you're interested in our modern portfolio theory, easy as a pie chart strategies, or even your own broker. How can you vet them? How can you go from just trusting and having blind faith to understanding whether or not you're really vulnerable? We'll get back to that. I'm going to show you a few more charts first. Okay, so again, you do not want to ride the Wall Street roller coaster, losing more than half in every recession and then spending the bull markets crawling back to even. It's just really not that much fun. I just want you to know that we do have testimonials. Some of them are on my website and on my bio. If that's what you're interested in, then email us or email my assistant at info@nataliepace.com, so that you can see the testimonials of people who've received a second opinion or who have saved their nest eggs using, again, Milo Bolden. I drew a pie chart on a napkin, and actually she earned gains in the Great Recession based on that pie chart. That's how easy it is. I get love letters all the time this time around from ACNAM. They had over 1 million at risk in a managed portfolio. I gave them a second opinion. They realized how vulnerable they were. This was a year ago. They got safe, and when everybody else was losing 35% just a month ago, they were like in tears with gratitude and sending me love letters. So again, if you felt uncomfortable over the last, few weeks, then now is absolutely the time for you to replace that discomfort with wisdom. And again, there's also, it's not just Main Street, although Main Street's important, because if it's a strategy you don't understand, how can you implement it? But I want you to know Wall Street as well has endorsed this. Nobel Prize winning economist, the chairman of TD Ameritrade, Genius Award winning economist at the University of Chicago, and much more. So you're welcome to look at these testimonials. We have them for you if you would like them. All right. And the reason that I do that is that it's important to grade your guru before you listen to anything they say. A lot of people make a lot of claims. In fact, if you wanted to just randomly look at blogs, you don't know how long that person has been blogging. They might have no experience, no economic experience at all, and they just really like writing, or they really think they're smart because they had one success. So it's really important to grade your guru before you listen to anything they say. And I'm happy to put myself to that test as well. So whether you want to see our track results or you want to see testimonials, email info@nataliepace.com, call 310-430-2397. We're more than happy to share. All right, so let's dig in. Now, again, we are in a recession, and I hope you have proof of it now. Also, I'm going to screen share just one more time where you can get additional information on it. Jamie Dimon has already shared this with JP Morgan shareholders. He shared that over a month ago. He was one of the persons that was fearful that we might be in more of a depression-like thing, Great Depression-like scenario. Again, I have great quotes from Jerome Powell, the chairman of the Federal Reserve Board. And this is where you can get additional information. After this call, I'm actually going to ask my assistant to post these blogs so that you can easily see them on our website. I have a Twitter feed there, so I'll put it in the Twitter feed. But if you're on Twitter, you can just go to my website and look at my Twitter feed and then click on the links. All right, let me share a couple things so you know how to get additional information. Okay, here we go. All right, so here's my bio. And again, if you just go to nataliepace.com and you click on the menu, you can select about Natalie Pace. And when you click there, it goes over to this page, which is my bio page. And you're welcome to read that. It's lots of information there. Also, I have a blog page. Again, same thing. If you're on the homepage at nataliepace.com, then just click on that menu and then click on blog, and that'll take you to this page. And on the blog page, the most recent blog shows up. But what we do to make it easy for you is at the end of that blog, I have a list of previous blogs. So if you want to know how to recession-proof your life, so the strategies that we're going over in this video conference, then you can click on that. If you want to know more about the data and statistics behind the recession, you can click on that one. You can click on this one. We are in a recession from March when we already knew. And this one, 21st Century Solutions for Protecting Your Home, Nest Egg, and Job. This is another one. A lot of the solutions we're going to go over today are in that blog. All right, so when we're in a recession, and I've been listening to earnings calls all day, so we got to do the same thing in our lives that the CEOs are doing for their corporations. And that is that we have to conserve capital. We have to divest non-essential bills. We have to keep our money. We have to look for and apply for every sort of help that we can. And and this isn't something that they're doing as much, but in our lives, I think we should look for intergenerational solutions. I was talking to my uncle, and the great thing about having, the elders' wisdom in your life is that they have experience. And he was telling me about one recession. I think it might have either been in the 70s or 80s. And he said that there had been this big housing boom. And it was a group of people in New Mexico that normally lived intergenerational. So they usually had 2, maybe even 3 generations in one household, but it became very cheap and easy to buy homes. And so they all, every generation went out and bought their own home. And then what happened is we hit this really rough recession, and all of a sudden, all these people couldn't afford their homes. So many of them gave the keys back and moved into one home, or selected the best home with the best amount of equity, and they all moved back into that home. They still owned it, and they gave the other homes up. So I think that I'm not suggesting you give up your home, but if you cannot afford it, and especially if you are underwater on the mortgage, then the sooner that you realize that, the better it's going to be. And a lot of people should be, and rather than thinking downsizing, you might be thinking upsizing. So in other words, if you can't afford your home, but it has a rental in the back that you could rent out, and then you can afford your home. Or if it has a mother-in-law guest house, or something that you can turn into a mother-in-law guest house, and take them out of their home. So everybody living in their own little tiny house is actually not that efficient. Of course, you have your privacy, but it's a very expensive way to live. So again, if you are in trouble on your home, then one of the things that you want to do is think intergenerational. One of the things, it's not the only thing. All right, so how can you preserve your wealth? I think the most important things are your nest egg, your home, your business, and your job. I'm going to start with your job because that one is the easiest one. If you have a job, keep it. Don't retire unless you really have to, because once you retire, it may be more difficult for you to re-enter the workforce. There's too high of unemployment. So keep your job if you can, and add another skill if you can. Make sure, if I were you, I would make sure that it's in social media or computing of some kind. I would get very good on Zoom. So whatever you do, if you have a job, keep it. If you don't have a job, learn a skill. And, I posted on that most recent one about this blog. I actually posted the jobs of tomorrow. So the skill you might learn might be kind of different than what you think. Like some of the jobs of tomorrow, the fastest growing jobs are actually trade skills. So do you want to install solar panels? Do you want to be a wind power engineer or technician. So look at the jobs of tomorrow and consider whether or not you want to maybe get a new skill. And go to apprentice.gov or apprenticeship.gov and see if there's an opportunity there for you. Not only, sometimes maybe you don't have to intern or do it for free. You don't have to go to a trade school. You might actually be able to get a job where you learn on the job. So you don't, don't have the costs of trade school and you're getting paid. So there are solutions for that. I also outline information on that, like should you go back to school, in my book, The ABCs of Money for College. And that was just published. I think the online edition, the Kindle version, is $3.50. So it's not going to break you to get that one. All right, the other low-hanging fruit is your nest egg. Preserve your wealth in your 401k, your IRA, your individual retirement accounts, your brokerage accounts. It now is not the time to have blind faith or to think that you can be an options trader or to any of these things. It is like surfing in a hurricane out there for anybody that is wanting to be an investor or even to preserve your wealth. So you have to know what you own. You have to know how safe, protected, hot, and diversified you are. You need to make sure that your safe side is really safe because bonds are losing money and are illiquid and having major problems. Now you might wonder why, because over half of the corporate bonds are either at the lowest rung above junk bond status or have been downgraded to junk bond status. So that's why we are having losses in the bond market, which is an abnormal for recessions, as well as illiquidity. So you have to know what you own there. A lot of people have bonds and they're very risky today. So the best thing for you to do if you are worried about your risk is to consider getting a second opinion from me. I'm not saying that so that I sell you into me. I'm saying that because it works. If I can tell you what you own. Now, why can I tell you and not your broker? Because I am unbiased. I do not manage your portfolio. I do not sell financial products. So I have no skin in the game. The only skin in the game I have is that you know what you own so you can be the boss of your money. And that's something I can do staying on the education side of things, is that I can tell you what you own. I can tell you how vulnerable or safe it is. And then I can outline ways, an action plan for you that would get you safe, protected, hot, and diversified. And then you are the boss. I'm not the boss. I'm not managing your money. You can choose to do whatever you want, but you can't be the boss of your money if you don't know what you own. And if you ask, the reason I began doing second opinions is that I assumed that people could work with their financial planners, but most financial planners don't really know how to analyze it properly. And that's because they're trained and hired as salesmen, not analysts. And also a lot of times they might even give you information that's slightly misleading. So I've had a lot of people that are sold into things and are told things are safe that are very, very high risk. So it's important for you to know what you own. And it's important for you to make the choices and be the boss. And now is the time to do that. So the other tools that will help you, let me share the screen because you can also start here and this will help. Although I wouldn't wait. Okay, so if you're at the homepage at nataliepace.com, oops, center it up for you. You can see here that you can click to try my 5-minute nest egg, pie chart, and Thrive Budget web apps. What that does is you can, in 5 minutes, answering 3 questions, get your own personalized pie chart and your own personalized Thrive budget. And that's going to be helpful both on the protecting your wealth side as well as fixing your budget side, because most of us are going to have to adjust our lifestyles and our budgets for a post-pandemic world. And again, you want, whatever your current salary is, if you have lost your job or you're on unemployment or you're worried about it or your income is reduced because you're an independent contractor, you got to kind of go from there and try to fix your budget based on that new salary. So those web apps can be helpful. They are free. You will have to enter in your email address, and then you get emailed the link to do them. So you may have to check your spam. If you sign, if you give us your email and you don't get anything, all you have to do is check your spam. It's there. Okay. Other things that you can use. If you're the kind that likes to read, then read the 3rd edition of the ABCs of Money. Click and it'll take you over there for that. You can also click here for the ABCs of Money for college if you think that you maybe should be learning a new skill, and read that section of that book. If you have a college student or a high school student, you should be having that book as well anyway. And of course, you can also consider joining me for my next online retreat. It's going to be June 13th through the 15th. And at the retreat, if you just click on that, you'll see, basically what it covers. But I'll give you what it covers essentially. Is on day 1, we have nest egg strategies. On day 2, all day long, we have strategies to get safe, and what's safe in a world where bonds are losing money and money market funds have redemption gates and liquidity fees. And then on day 3, we have what's hot and how to avoid the bailouts, those companies that are either at junk bond status or in danger of being downgraded to junk bond status. So you have a number of tools that you can get started with now. A free personalized nest egg pie chart and Thrive budget, very affordable books. So the ABCs of Money, I think it might be only $3.50 in the Kindle version. It's probably $9.95 in the print edition. Very similar for ABCs of Money. And then of course, if you want to join us at the next retreat, you can learn the ABCs of Money that we all should have received in high school, and implement the strategies there. And if you are interested before that in knowing what you own, then you're going to have to just email or call our offices for a second opinion. And you can call 310-430-2397. The phone number is right there on the website, and the email address is on the website as well. So you can fill out their form, or you can just email us. All right, so let me go back to my notes and make sure that I've gotten everything. So saving your nest egg is knowing what you own and then acting to protect it. Saving your home. Again, if you can afford your home, great. If you're wondering whether or not you should pay it off, if you just lost your job and you're able to pay off your home and get that stress off of you, that might be something to consider. For most people, the best thing to do is to align the payoff date of your mortgage with your retirement date. And for most people, you do have a very low mortgage rate, so that's something to consider. If you're over leveraged on your home and you really couldn't afford it in the first place, or if your home value lost like 1/3, would you be underwater? So these are all things that you want to be considering on your home if you own it. If you don't own your home and you're thinking now might be a good buying opportunity, be careful, like don't just rush right in. The reason is that the Great Recession started in 2007. The low, even though real estate started its implosion then, the low for real estate didn't occur until 2011. Now, we're finding that things are moving much, much faster in this recession than they did in the 2 previous recessions. Part of that is because of the over leverage. So I will show you another chart that I want to go back to. But now is the time to protect your nest egg. So your 401k, your IRA, protect your home. You got to do the math and see if you can really afford it. Do the math and see if you'd be underwater on the mortgage if it lost 1/3. I think that's a good idea just to make sure, because if you go underwater on your mortgage, you really that's a real problem. First of all, your FICO score goes in the toilet. It can lock you in there for another decade, even if you wanted to downsize and move somewhere else to retire, or if you had a job opportunity that was somewhere else, you might be stuck where you are. So these are all considerations on your home. If you have your business, I would say one thing right now: do not siphon money out of your nest egg, out of your 401k or your IRA, to try to save a business that just has no sales right now. You have to reconsider that. And be careful with debt too. A lot of people think with their stimulus that they should just be paying down debt. And the truth is that right now you should be protecting your own future first. And part of the reason why you keep the money in your 401k and your IRAs is that that money is protected. If you have to restructure your debt, or if you have a home foreclose on you for whatever reason, they can't touch your retirement accounts. That's important to know, and that's one of the most important reasons why you don't siphon money out of it to save a home you can't afford, or to save a business that is not paying you. Very important stuff. So let me show you one more thing to show you why this recession might move more quickly. So this recession moved more quickly from a bull market to a bear market than we've ever seen in history. The losses in less than 3 weeks were 35%. That was faster than we've ever seen in history. Obviously, the rise in unemployment is faster than we've seen in my lifetime, in many people's lifetimes. It might not be as fast as the Great Depression, but it looks like we're going to start rivaling some of those records too. So let me just show you something, because I think this is important to factor in. And I think this is important to factor in, not for political reasons, but for just information reasons. So before the Great Recession started, this is a bubble chart that I've been letting everybody in on. This is from January 2020. This is well before we had our first case in the US. It's well before we had our first stay-at-home order, which happened, I believe, around March 15th in California. So January 2020, and it's before we hit the market high. In January 2020, the politicians were all saying the economy was doing great because we had low unemployment and because the stock market was high, and also that real estate had recovered. Well, that's the case always before recessions. So before the dot-com recession, it was pretty much the same thing. Before the Great Recession, it was the same thing. But the problem is we've had the 21st century. I told you it was different than the 20th century. And the reason is that we haven't had real economic growth in the 20th century. A lot of that, it's not the fault of the politicians. It's because we have too many people retiring. So we used to have 13 people working for every retiree. Now it's under 3. So when you have so many people retiring and they're living longer lives and healthcare costs are astronomical, your economy slows down. That's just the way it goes. Japan had that before we did. They started that in 1980. So what we've done in the 21st century to help offset that is we've had asset bubbles, and that has made people feel very rich until they pop. So let me show you what that looks like. And if you think about it for a moment, what was the asset bubble before the NASDAQ or the dot-com crash? And it was the dot-com stocks. What was the asset bubble before the Great Recession? And it was obviously real estate, but also it was the financial markets. And then this time around, it's all of the above. We have an asset bubble in stocks, and I can show you other charts that would help you with that, or you can take a look at my recession blog so you can see the other charts on that. We had an asset bubble in real estate. Real estate at this point was unaffordable in 74% of the US, unaffordable. So the only thing that was fueling it was low interest rates. And by the way, Guess what low interest rates do? They create asset bubbles because the money flows to the richest people and the business owners. And that's good because they can create jobs. But if they start creating asset bubbles, again, initially it feels really good because you feel rich. But if it's unaffordable real estate, there's a whole group of people where it does not feel really good to. And those people are your potential buyers. So that's a problem. So back here for another couple of things that I think are very important for you to realize. All right, so I'm going to now shift over to the asset bubble chart that's more current with today information on it. But again, I wanted you to see this one from January so that you would know that high stock market prices and high real estate market prices are not the only indicators of whether or not an economy is healthy. So here we had consumer debt that was astronomical, public debt astronomical, corporate debt astronomical, pensions severely underfunded. At the top of the market, the pensions are supposed to be overfunded, but they were not. GDP growth very, very low. And this is the key here. Look at the Fed fund rates. You can see that before the dot-com recession, we started at 6.5%. Before the Great Recession, we started at 4.75%. Before this recession, we were starting at under 2. And now we currently have 0. Now, before your eyes start glazing over, because I'm going to stop and I'm going to go back to questions, it may be too much data for you. I just want you to know that the reason that bonds are in trouble also has to do with that interest rate. We are starting out too low, and Jerome Powell has been warning about that for a couple of years. So when the economy hits a recession, they cut interest rates, and that helps to boost economic growth. And that also helps to make your bonds increase in value. So the safe side of your nest egg helps you to have performance. This time around, because we have interest rates starting out at 0, they can't cut them. So bonds are not going to do well. In fact, they're in trouble. And that's why it's really important for you to know what you own, because stocks always lose money in a recession. And this time bonds are too. And that's usually where you can stay safe. So if the at-risk side is going to be vulnerable to capital loss and the safe side is as well, then you need to know how to keep your money. All right, I'm going to answer a couple of questions that were emailed into us prior. And then I also want to give you some information so that you can follow up and do what you need to do to recession-proof your life. Again, the number one thing is I will post those blogs, or my assistant will, within an hour on my homepage. So just go to nataliepace.com. Access the free web apps, access my books if you want. Learn more about the retreat. You can email info@nataliepace.com or call 310-430-2397 if you want to learn more, or if you're interested in registering, or ask questions. There's no pressure to buy anything. And you can also join me on my next video conference. I'm doing them about 2 times a month. Sometimes it's just me updating you on something, and sometimes it's me interviewing somebody. So when I was interested in gold, we interviewed Rob McEwen. You can visit my YouTube channel, which is youtube.com/NataliePace2. And you can access the playbacks of these free video conferences. We have some that are just for subscribers, or the retreats are recorded. The online retreats are recorded. They're just for the retreat attendees. But we also have the free ones, so twice a month. If you have a question that you want me to address in our free video conference, you can always email it in prior to the video conference and we'll add it to the list. So I'm going to go to the questions that were emailed in. Let me see if I can find them real quickly. There we go. Okay, so the first question was, we've heard that what do you do if you know little about investing and have relied upon your 401k plan administrator or a person or a brokerage house to set you up in mutual funds and other things with investments you know nothing about, or pages and pages of different investments that you don't understand? So the first thing I'll tell you is that if you have like 15 or 20 pages of holdings, that's a red flag. If you have checked off blindly in your 401k, that's a red flag. If you have a 401k or an IRA and you don't know what you own and you're just relying upon the other person to do it for you, that's a red flag. And you need a second opinion. That's just the bottom line. You need to know what you own. And relying upon the broker salesman to do it for you can work out maybe a small percentage of the time. I got into this business because in August of 2000, I was approached by a broker salesman that my bank referred me to because I'd made a lot of money in real estate. And he wanted to put me into the stock market, and he told me it was an all-time great time to buy because stocks were so low. This was August of 2000. The stocks had come down a little bit from March of 2000, their high. But if I had invested in an energy fund anchored by Enron, in a telecom fund anchored by Global Crossing, in a .com fund anchored by AOL, in an international fund anchored by Japan, it would have destroyed my life. It wouldn't have just been, maybe I can recover. It would have destroyed my life. So I think it's really important for you to understand that most of the time, the person that you're going to talk to at a brokerage house is a broker salesman. And you need to know what you own and you need to be the boss. And especially if you ask questions and they don't answer them in ways that make sense, or they're not willing to give you an easy pie chart. And actually, even the easy pie chart that they might give you might be a little deceptive, because I have seen pie charts where it's one fund and they try to make it look diversified, but one fund is not diversified because you can't see and capture your gains. And 20 pages oftentimes is not diversified either. It's usually only large cap value, a boatload of it, a small amount of large cap growth, and then a boatload of bonds. So you need to know what you own. There's really no exception to that. You can read about it in my books, or you can get a second opinion, or you can attend the retreat. Chances are that you might do okay if you wait until the retreat, but I wouldn't necessarily count on that, because even though we're not going to get the definitive bad news until July 30th, other things can happen. Neiman Marcus just declared bankruptcy. A lot of the bad news has kind of been pushed out until at least August or September. So most of the second quarter earnings are announced in August. The airlines have, and a lot of the auto manufacturers, a lot of the payroll loans that have been given to the big corporations they don't run out until the end of September, right before the election. So it's important for you to know, because when these things run out, that's going to be a boatload of bad news. So again, wisdom is the cure, and the time is now. It's way better to be early than to be late. If you wait for the headlines, it'll be too late, and it's like trying to catch a falling knife. It's very bloody hands. You do it beforehand, and you know what's going on, and you can sleep at night, and you can protect your wealth, and you can make the hard and brave and necessary choices that you need to make to preserve your home, preserve your nest egg, preserve your job, preserve your future, invest in your future, but not foolhardy. Don't drain your nest egg to invest in your future without a real good reason to do so, or a real good plan. So thank you for joining me. Oh, there was one more. Sorry, one more question. Let me get back to that one. I'm going to let you look at something while I read it, because I don't know. I'm not good yet at reading, whatever the online people show you. So hang on. I'm going to show you a picture while I read it. Not that one. Let's get a good picture up there. That'd be more fun. This was kind of fun, the earnings reports for the cannabis companies. There were some really interesting things in there. So I'll let you look at that while I read this next one. Sorry, hang on. Oh, okay, here we go. So this person, she was freaking out because the markets were going up. And she's like, look, I got out, you know, I trimmed back and then the markets went up. What's happening? I'm freaking out here. Why is that happening? So let me go ahead and show you what was happening for her and why she was so worried about it. So here's the Dow, and here's the performance on the year. So what happened was the market high was about February 19th, right about there, 29,568.57. And then between February 19th and right here of March 23rd, 2020, the market had dropped 35%. Now, as you can see, it's come back a little bit, but it's still down about 20%. So she's like, well, why did it come back at all if we're in a recession? I just don't get it. And the reason that happens is those broker salesmen. I saw an ad on Twitter from one of the major brokerage houses, and it was so heartbreaking because they had obviously hired a broker associate who was reading a teleprompter. And this person was having to say, and you could tell they didn't even believe it, that these were once in a lifetime opportunities to buy stocks. And again, if the markets drop by half, it's not a once in a lifetime opportunity. But I do want to stress one more thing. The easy as a pie chart nest egg strategy is not market timing. Market timing doesn't work because it's really running off of your emotions. What it is that you always keep the appropriate amount safe and you're always properly diversified. You rebalance annually because that's a buy low, sell high plan on autopilot. If you have a diversified pie chart and one of your slices gets really big, it's telling you sell high and trim it back to where it should be. If one slice gets really small, it's telling you buy low. So the plan itself works great. You rebalance 1 to 3 times a year. Once you're properly diversified, you could manage it yourself without a problem, although you can always hire somebody else to do it, but it just makes being the boss of your money much easier. All right, I want to thank you so much for joining me today. I hope I've been helpful. Again, it's not alarmist. I think that you should be prepared because it doesn't take a genius or a prophet to see that we have, you know, over 21 million people unemployed, that we are doing our best to, you know, fix leaky boat here. And we are way over leveraged. I think that this asset bubble chart should be something that you should be very cognizant of. One of the reasons why everything is heightened, why the markets are going to drop faster than normal, why the bond market is worse than normal, is because the financial conditions before this happened were terrible. Now, they even asked Jerome Powell about this, and he was like, look, yes, we should have done a better job before. And not, by the way, him. He was trying to raise interest rates, and he was getting blowback severely from the White House. So I'm not saying it's the White House's fault. I'm not saying that you should vote this side or that side. It's hard to know whether any president at all could have fixed this, because all of them are going to be tempted to try to keep the economy going. And at the late stage of the business cycle, what else can you do but create an asset bubble? So the bottom line is this: if you have the right data, the right information, if you're forward thinking, and if you are willing to make hard choices and brave choices and choices that will preserve your, again, all these things are things I'm hearing from the CEOs when they talk about saving their businesses. Conserve your capital, divest non-essential, non-core expenses. And by the way, you can save thousands of dollars annually with smarter big ticket choices and smarter energy choices. And that's outlined in the retreat, and it's also outlined in the ABCs of Money. So there are ways that you can do this. If you just think it's a bill, then you can't do it. If you think, I'd like to stop making the tax man the debt collector, the landlord, the car company, the car insurance company, the health insurance company. There are solutions for all of these things. So if you are making everybody else rich at your own expense and you want to thrive budget, then you have to get the big ticket solutions. It's not a matter of being prudent or cutting out cafe lattes. Yes, you can save hundreds by cutting out cafe lattes if you're an absolute fiend over Starbucks, but most of us are not. Most of us are not shopaholics either. You can save thousands annually with smarter big ticket choices and with smarter energy choices. And that, my friends, is where the magic lies. I look forward to seeing you again. I'll probably have the next fireside will be on a third. We usually do them on Thursdays. I kind of like this 5 p.m. time. So it'll probably be not this Thursday, but the following Thursday at 5 p.m. And I may talk about hot stocks at that time because we have some that are pretty hot. All right, see you then. Thanks again. And FYI, if you want to watch a recording of this or if you want to share it with people, I will be posting it on my YouTube channel. Again, that is going to be youtube.com/Natalie Pace 2. Thank you guys. Really, thank you for joining me. Send me your questions. We are in this together and we have a beautiful community of very smart people. And let's solve problems. Thanks.